and we're going to get started with our virtual workshop today called The True Cost of Home Ownership. My name is Amanda Bollig, and I'm a Home Repair and Learning Center Specialist here at Loudoun Habitat for Humanity, which means I have the joy of overseeing our Tools for Life Learning Center. We have quite a bit to discuss today, so we're going to dive right into things by going over our goals for the workshop today. We're going to be talking about some of the costs associated with purchasing a home, and then we're really going to go a little bit deeper and talk about what's actually included in your mortgage. We'll also discuss budgeting for maintenance costs, because as a homeowner, that is something you are now responsible for. It's not like being a renter anymore. And then we'll kind of wrap things up, and actually kind of through the course of the entire presentation, we'll be discussing planning your spending. Joining us today is Teresa. Teresa is a master financial education volunteer with the Virginia Cooperative Extension. And Teresa volunteers her time by teaching classes just like this one to families across Virginia to make sure that they're financially prepared for homeownership and they have great money management skills. So we're very excited to have her joining us today. And she will share a little bit more about herself. Here's Teresa in just a moment. But I do want to give one quick instruction before I pass it off to her. If you have questions during the course of the presentation, you can put them into the chat box, but we're not going to answer them until the end of the presentation. So we'll let Teresa get through all of her content, and then we'll have a dedicated question and answer time. But if you have a question and you don't want to forget it, by all means, you can throw it right into the chat box and we'll keep track of that and make sure it gets answered at the end. So with that, I'm going to pass it off to Teresa. She's going to share just a little bit more about herself, and then we'll get started with her first slide.
Okay, hi. Again, my name is Teresa Germain, and I live in Arlington, and I'm a master financial volunteer with Virginia Cooperative Extension. What we provide is free personal financial information, classes, and counseling to people in the localities we serve. These are like non-biased and research-based information. And we're sponsored by Virginia Tech. And we get a lot of our information from Virginia Tech and Virginia State University, the two sponsoring universities for extension. We're very happy to be here today to talk about the true cost of home ownership. And why don't we just move along? Could we see the first slide? So I expect that most of the people here are buying their first home. And I just want to go over the types of housing that you might be looking at. The first is a single family detached house. That's usually a house with a yard. And it typically doesn't have a homeowners association unless it's in a planned community or like a subdivision. Then townhouses, which are attached houses, usually multi-level, and also shares one or two walls with their neighbors. These can have like small homeowners associations with like low fees in general. Then there's condominiums and cooperatives. These are multi-story buildings where people live like similar to apartments. Condominiums, the buyers usually buy the actual unit, whereas in cooperatives, you buy a share in the overall building. So it's like an ownership difference. And finally, manufacturing housing and mobile homes. When you buy this kind of prefab home, usually they can be moved. And the people who live in these mobile home and manufacturing housing communities either can buy the land that their unit sits on, or they can pay ground rent, similar to rent as you pay for like an apartment. Next slide, please. Reality check. As you're looking to buy a house, the first thing you need to analyze is what can you afford to spend. A budget is critical in this. I don't know how many of you have actually looked at your budgets, but it's very important to do that. A budget is the money that comes into your household every month in the form of income from jobs, from interest income, from alimony and child support, that kind of thing. And you look at that versus the money that goes out, essentially rent, food costs, childcare, things like that. And it's important to look at your fixed versus variable expenses. Your fixed expenses are what you have every single month. Again, rent, utilities, childcare, even food expenses. You might have a budget. You spend $400 a month in the house for food. Variable expenses are things that happen, monthly, but vary, depending on what you spend that particular month, like entertainment, restaurant meals, vacations, and that sort of thing. And you're just walking around money. It's important to look at your budget over 6 months to get a feel for how much you can actually afford when you're about to buy a house, how much you can afford in a mortgage payment per month. How much you can afford is determined by fundamentally the interest rate that you're going to get from the bank. And what determines your interest rate is a bunch of different criteria. One of those is net worth. That's how much money you'll have overall. Your assets minus your liabilities. Your assets are things like savings accounts, retirement accounts, other properties you might own, that kind of thing. Your liabilities are credit card debt, student debt, that kind of thing. So the bank will look at your assets versus your liabilities and determine your net worth. The higher your net worth, the lower the interest rate, because the more money you have, obviously, the lower risk that you walk away from your mortgage. The second thing that determines how high your interest rate is your credit score. I'm not familiar with how much you guys know about your credit score, but one thing I do want to point out is that a credit score is your track record on how good you are at repaying your debts. There is a very good source for what your credit score is. If you don't know what it is, you should go to annualcreditreport.com. This is a service sponsored by the FTC and in cooperation with the 3 major credit bureaus, Experian, Equifax, and Transamerica. If you go there once a year, you can pull your credit report for free. There's a lot of scams out there about getting free credit reports. This is the only one that is sponsored by the FTC and the federal government, and there won't be any shady dealings with this. So I really highly suggest this website. Another thing is your debt ratio. How high is your debt to your level of income? The bank will look at that when they determine whether your interest, what your interest rate is going to be. The higher your credit score and the lower your debt ratio, the lower your interest rate will be. And then finally, the down payment you bring to the table when you buy the house. Usually down payments range anywhere from like 3 to 20%. The higher your down payment, the lower of a risk you'll be to the bank, because the bank figures if you pay 20% down, you're not going to walk away because that's money you're going to lose. Okay, so next slide, please. Spending plan changes. When you're a renter, you pretty much pay your rent and maybe a renter's insurance premium. Sometimes it's even included your rent. So you're not paying a bunch of different things, but paying a mortgage payment is a lot more complicated. There's 4 different components to your mortgage payment, and it's popularly known as PITI: principal, interest, taxes, and insurance. We're going to talk about these more in depth throughout the presentation, but right now we'll just give you an overview. The principal is the amount of money that you've borrowed that you have to pay back from the bank. Let's say you want to buy a house that's $500,000. You put $100,000 down. Your mortgage amount is $400,000. The principal in your mortgage monthly payment will be that $400,000 divided by, let's say for a 30-year mortgage, 360 months. So your principal per month will be about a little bit over $1,100 in that scenario. The interest rate, for people who don't know what this is, the definition of an interest rate is the amount the bank charges for you to use their money. Essentially, what it is the cost, that to you to allow the bank to lend you the money. It's usually expressed as an interest rate, in percentage terms. So, essentially that's the profit the bank makes on the mortgage. You can look at it that way. Current interest in mortgages right now are between like 3.8 and like 4.1 in general for different mortgage programs. For that $400,000 mortgage you might get, an interest at like 3.8%, which is like the prevailing rate for a 30-year mortgage right now, would be about $766 a month. So that gives you an idea. So your principal plus interest is almost, it's about $1,877. Also included in your mortgage payment are taxes and insurance. You're going to owe property taxes to the locality that you live in. In most of your cases, I think that's Loudoun County, and you'll owe Loudoun County property taxes to provide your home with roads, policing, firefighters, and most importantly, schools for your kids to go to. And finally, insurance. There's a couple of different insurances that you're going to have to pay as part of your mortgage. One is homeowners hazard insurance. That is, kind of an insurance to make sure that if the house is destroyed, the lender can recoup their money, and that you can actually rebuild if that's what you like to do. If you want to walk away, the lender will just get the mortgage insurance money and then sell the land. Also, spending changes. Renters insurance usually includes what's in the house. Usually, a lot of times it's included in your rent. Homeowners insurance, in this case, we're talking about the property within the house, like the appliances and furniture, things like that. If that's destroyed by fire or flood or whatever, homeowners insurance should cover it. It's usually a rider on your homeowners hazard insurance that the bank requires you to take when you get a mortgage. Next slide, please. Monthly housing costs. Now we're going to talk about like what's in escrow. Has everybody heard the term escrow? I hope you have. What that essentially is when you get a mortgage, there's certain subset of charges that the bank collects from your mortgage payment and puts aside for certain aspects of your monthly mortgage. For instance, if you, in that situation where you had a $400,000, mortgage with, let's say, Bank of America or whatever, they would collect the $1,877 in principal and interest, but then they would put the rest of the money, which is about, I don't know, $600 or $700, into separate categories to pay off your property taxes, which usually are collected twice a year, maybe I guess it's like about $4,000 a year, so maybe $300 there. They'll take out $300 every year and put it in your escrow account. They'll take out money for your homeowners insurance, usually anywhere between $100 and $300 a month, and put that in your escrow account. And then if you have mortgage insurance, which is if your down payment is less than 20% and you have to pay PMI, they will also take that out and put that in your escrow. So overall, of a like $2,500 mortgage payment, about between 2/3 and 3/4 of it goes to principal interest, and the rest goes into this escrow account. And your mortgage servicer, who is the person who administers your mortgage, will pay your property taxes, your homeowners insurance, and your mortgage insurance for you out of that like pot of money that they're holding aside from your mortgage payment. Also, homeowners association fees mostly go in the escrow account as well, but not always. And that's something you're gonna have to find out depending on what house you buy. You'll have to figure out if it's included or not. You might have to pay it as a side issue. Next slide, please. Other things you need to pay in addition to your mortgage. You have to pay maintenance on your property, painting, fixing a roof if a shingle falls off, repairing gutters, that kind of thing. Also, you'll have to pay for landscaping, somebody to mow your lawn, or maybe you'll do it yourself, so it won't cost you. Also, it's anything that you do to improve the curb appeal of your home, planting a tree, putting in flowers, that kind of stuff. Utilities, you've got gas, electric, water and sewer. These are things that have to be paid. And that's your responsibility now. A lot of times when you're a renter, that's included in your rent. But as a homeowner, you'll have to pay that yourself. Furnishings, more house means more furnishings. You'll need more tables, chairs, sofas, beds, all that. So that's something to consider. Also, appliances in general, when you rent, the landowner or the landlord will provide you with appliances. When you own your own home, if the refrigerator goes on the fritz, it's your responsibility. And finally, communication and media networks, you're going to have to pay your own, Fios, Comcast, Cox, whatever you have for phone, internet, and cable TV. Next slide, please. What is the mortgage? We're going to go here more into depth of what this actually is. A mortgage is a loan secured by the property or house. This is kind of different than most consumer loans. Most consumer loans are secured by the income of the person who the bank is lending to. But a mortgage is actually not secured by your income, it's secured by the house itself. This is why mortgage rates tend to be much lower than other consumer loans. And the reason is, if you decide to not pay your property, your mortgage, the bank can foreclose on your house, take back your house, and sell it. So it's a lot less risky than just lending you money that you may never pay. They can actually, take the real asset and sell it to recoup their losses. Your mortgage is paid installments over a set period of time. Most mortgages are either 30 years, that's the most prevalent, which is like 360 months, over a 30-year time period, or 15-year mortgages, which is about 180 month term. And what it does is it secures your promise that the money you borrow will be repaid. For most of us, the mortgage is by far the largest and most serious financial obligation you ever make. What is also important to remember here is it also is the largest store of wealth most people will have in their lifetime. So, when you pay off your house over 30 years, when you look at retirement, a large preponderance of your net worth will probably be your house value. So you can sell it in retirement and, go retire, or you can keep it, but a larger part of your wealth building over your lifetime will be your house, and your mortgage is the way that occurs. Can you go to the next slide, please? Okay, planning your spending. This is something that is very personal. Different people feel that, comfortable at a different level of house payments, and a lot of it depends on your personal situation. Let's say you're a tenured professor, or you work for the federal government as a clerk, or, you work for the city, as a secretary or something like the city or the county of Loudoun, and you have a very stable employer, and you feel like you're at the beginning of your career and you have a lot of prospects for income increase. In that case, you might be willing to stretch to buy a house because you think that your prospects are good and the likelihood that your job will be, eliminated, or that you'll have a problem is low. So in that case, you might want to, stretch a little bit and pay a little bit higher of a mortgage payment every month. But for other people who have maybe, not as secure of employment, or, they just are not comfortable with, paying, high mortgage payment, they may be just comfortable with spending for their mortgage payment what they paid essentially for their rental when they were renting an apartment. And that's fine. Again, it's something you're going to have to determine for yourself based on your personal situation. It's not necessarily your comfort level, what your lender says you qualify for. which, by the way, most lenders have a lending guideline of about 28% of your gross income. So let's say you make $4,000 a month. That means that you can probably borrow up to $1,120 a month for a mortgage. The other qualification criterion is that total debt can't be more than 36%. So on top of that $1,120 of that you qualify for the mortgage, you can't have more than another $320 a month in other debt, like student loans or car payments or a credit card debt, that kind of thing. So your maximum debt level can be 440 and your home payment can be like 1120. But those are maximums. Again, you should go with what your comfort level is for determining your house payment. Next slide, please. Again, comfort level. Here's an example. Like, let's say Kim's rent is $975 a month. Kim is, anticipates that the home she wants will cost her about $1,350 a month. What Kim should do is start saving $375 a month additional, because that's the difference between the new mortgage payment and the rental payment she pays, to see if she can actually swing the house payments. 6 months is a good amount because that gives you a real good snapshot of what you can afford and what you can't afford. If Kim starts saving the $375 and finds she just can't come up with the money every month, she needs to reevaluate what she thinks she can afford to pay in a house payment. Next slide. Okay, savings here are your life preserver. I think everybody probably, given the COVID situation, is sensitive to the fact that emergency funds are very important right now. A lot of people lost their jobs during the COVID pandemic. Also, remember back to 2008 when the economy tanked after the mortgage crisis. A lot of people lost their homes. A lot of people couldn't get jobs for like over a year. So I would say that given current market situation, we should all think in conservative terms. Most personal finance experts say you should have at least 3 to 6 months in an emergency fund, but I really highly suggest, given current, market conditions, that you go on the higher end of that. So you really should try and save at least 6 months of living expenses to help sustain you in housing costs if you should get ill or should you lose your job. Okay, because things happen. You should also be sure you should prepare for like periodic expenses like insurance, taxes, birthdays, holidays. We're going to talk about putting aside a contingency fund later on in this for home maintenance a little later in this talk. Also for home maintenance items, like regular things that you have to do, like checking your furnace and changing filters in your air conditioning, that sort of thing. And then replacement items, like if you need a new refrigerator or whatever. Next slide, please. In addition to the monthly mortgage payment you're going to be paying regularly over the next, let's say, 30 years, there's also upfront acquisition costs of home purchase. When you buy a house, they have to originate a mortgage. You have a bunch of things you have to do to qualify and also to make sure that your purchase is solid. And these are the upfront costs. And here's a list of some of the things you're going to have to have. First thing is a down payment. We talked about this a little bit. Usually people put down somewhere between 3 and 20% of the purchase price as a down payment on the property. If you put more than 20% down, you do not have to pay private mortgage insurance, which can save you about $300 to $400 a month. So it's definitely worth it to put down more if you can do so. So 3 to 20% of the home's purchase price for the down payment. Earnest money deposit. Let's say you pick out a cute condo in Sterling, Virginia, and you decide you want to buy this. You provide an offer to the owner's real estate agent, and they like the the offer, while you secure your mortgage, do the home inspection, all that stuff, they want to make sure that you're not going to walk away. So that they usually ask for a small amount called an earnest money deposit. Usually not very much, like between $500 and $2,000, just so that they know that you're serious and to compensate them for pulling the house off the market while you get your mortgage, home inspections are done, and all the, administrative hassles are done. Usually takes a couple of months. So that's what you're going to need some money for the earnest money deposit. Home inspection. Absolutely critical that if you're buying a home, you get a home inspection. Sometimes people try to skip this. Always a bad idea. You want a certified home inspector, and most banks require it actually, to make sure that the house you're buying is sound and that there's no hidden defects. This usually costs around between $250 and $400 for, for that inspection. So that's something you'll have to have up front as well. And then closing costs. These include the processing fees your bank requires to originate your loan and to, transfer title and do all the administrative stuff up front so that you can actually own your home. Includes like real estate fees, tax payments, title expenses, mortgage processing fees, and other fees. And then finally, and this is one that people forget a lot, the cost of settling in. After all this stuff is done, you bought your house, there is cost to actually moving in. First thing is the cost of moving. And, you can hire, a moving company to do it, to move you from your rental apartment to your new home. Or you can like rent a truck and get your friends to help you do it. It's a lot cheaper to do it that way. Just depends on what, your ability and what you want to do. The second thing, and this is something people forget all the time, utility deposits. Once the home transfers ownership, you're going to have to get electric, gas, water, and sewer turned onto the property. Most of those, companies and also the locality for the water and sewer will require you put a deposit down so that if you don't pay for a couple of months, they're not going to be out money. So I would say that between 200 and 700, maybe say average 500 per utility, they're going to ask for a deposit. If you have a track record with them, like if you paid your electric in your rental apartment separately, you might avoid this or you might get a much lower utility deposit. But that's something to really remember. I would budget somewhere between $1,000 and $2,000 for utility deposits as you move in. And finally, appliance and furniture, purchases, because you're moving into something bigger. You might not like the refrigerator. Who knows? You want a gas stove instead of electric. These are costs that you'll have to come up with. Next slide, please. Okay, this is a really good infographic, which kind of gives you a whole view of, your mortgage payment. Again, your principal, we're going to talk a little bit about it, again, more in depth here. Your principal is the money that you're going to pay back to the bank. Again, on a $400,000, home mortgage over 360 months, you'll be paying about $1,111 a month. So that's one component. Number two, your interest and your mortgage insurance at prevailing rates, which are now in Loudoun County around 3.816% as of yesterday. Your interest rate will be your interest cost will be about $766 a month. So your principal and interest will be $1,877 for that $400,000 mortgage. And if you need mortgage insurance, that'll probably be, usually mortgage insurance is between like 0.5% to 1.83%. Most of the time it's around 1%. So on that $400,000 loan, if you have to get mortgage insurance, it'll be about $4,000 a year or $333 a month in addition to the $700 in interest expense. And then in the middle here is all your escrow items. Again, your property taxes, that's what your locality charges you for all the services they provide to you. Again, roads, schools, policing and firefighting. In Loudoun County, the property tax rate is just under a 1%. So for a $500,000 house, it's based on your house value, not on the mortgage value. So for a $500,000 house, it's around $4,900 in Loudoun County, or it'll cost about $400 a month in property taxes. And that goes into your escrow account. Okay. There may be town taxes as well. They tend to be small, but I think there are some places in Loudoun County that charge that, but most places don't. Okay. And then your homeowner's insurance also goes into your escrow account. That's usually between like $100 and $300 a month, depending on the value of the home insured. So, for that $400,000 house, I looked up, what a home insurance would be, and it's about $194 a month. And that goes into your escrow account as well. And your servicer will disperse that to your insurance company. And then finally, homeowner association fees, if applicable, that could be in your escrow as well. Next slide, please. We'll get a little bit more into the weeds on the insurance. I'm not going to go into this too much. Again, mortgage insurance, I emphasize that anybody who pays less than 20% down as a down payment will be required to do PMI, which protects the lender in case the borrower defaults. Okay, so one of the things that's important to realize about PMI is it's not forever. It's not for the whole term of the 30 years of the mortgage. It's only until your equity hits 20%. So if you put 3% down and your house appreciates, let's say 10% one year and 7% the year after that, in 2 years, your house equity is worth 20% of the total amount of the house value, and you can stop paying PMI. The deal with PMI, though, is you have to tell the lender when you hit that 20% payment that you want to drop PMI. If you do not tell them that, they will just continue like collecting it and putting it in your escrow. So it's very important to every year really look at what your home value is and how much equity you have in your home, because then you can drop your PMI, and that could save you, $300 a month or $4,000 a year, which is really, why pay it to the bank if you don't have to? Okay. And then homeowners insurance. Again, this is, mostly hazard insurance. As a condition of the loan, most lenders require people to have hazard insurance. Usually, again, based on the value of your home, if it's usually between $100 and $300 a month. Here's the homeowner tip: whether you're required to have homeowners insurance or not, you should have it, because if your house is destroyed, let's say you're a retiree and you've paid off your mortgage, you don't have to have homeowners insurance, so you don't have it. If your house is destroyed due to a flood or a hurricane, or it burns down because you have a gas fire, you're out of luck because you don't have homeowner insurance anymore. So it's important that people maintain homeowners insurance even if they paid off their mortgage. Next slide. HOA fees. Almost all condominiums and some townhouses and single family houses that are in like planned communities and subdivisions have homeowners associations that collect fees, and they need to be included in your monthly budget. These can range really widely, and it depends on the area you buy in. Can go from $100 to over $1,000 a month for like a luxury condo or whatever. These fees usually cover maintenance and improvement of common areas, lobbies, building exteriors, gardens, and pools. Properties with pools on site tend to have much higher HOA fees. So that's something to consider. If you're going to use the pool, it might be worth it. If you're not going to use the pool, maybe buy in a place that does not have a pool, because that really jacks up your HOA fees. Homeowners fees tend to be clearly stated as part of the real estate listing. But I would also ask the real estate agent, your real estate agent, when you're buying, to check to make sure there is fees or there's not fees and what they are. Another thing you can ask your real estate agent to do, because after all, they're working for you, is you can ask them what the history of the HOA fee increases are and how often it happens. And she can probably get that from, the homeowners association. You also can look on the internet, and actually, if you Google the condo complex, or like, let's say, the homeowners association for a single family like planned community, there'll usually be complaints or things saying, giving you an idea about how much the HOA fees increase and how often that happens. A lot of times HOA fees are in the escrow and things like planned communities and subdivision, but sometimes it's not. It's also something you should ask when, before you purchase a home. Next slide, please. Property taxes. Again, they vary by jurisdiction. In Loudoun County, as I said, it's just under $1 per $100 of your home's value. So again, it's calculated based your value of your home times the tax rate. Two factors that are included in it are those two things. So for that $400,000 home we were talking about earlier, your property taxes would be about $4,000 a year, or about $330 a month. And as you're working out the cost of owning a home, you really should keep in mind how much property taxes can go up. The tax rates tend to go up in along with the rate of inflation, maybe a little bit more, but they're pretty reliable. The thing that's the question mark is how much your value of your home goes up or down. Lately, housing prices have gone up quite a bit. I will say that my property taxes last year went up 16% because the value of my home went up 16%. You should take that in mind as you consider the true cost of home ownership. Next slide. Okay, responsibility of home ownership. This is something everybody knows, but we're just going to go over it again. It's important to pay back your loan on time. If you don't pay back your loan on time, you're late constantly, you're going to be paying a lot of late fees, and they can be substantial on mortgages. So keep that in mind, that you want to be regular on paying your loan. Actually, you can do it as an automatic debit from your checking account, that's the way to go. So you're not late. If you're late too many times, the bank can foreclose and take your home. So you don't want that to happen, because you're going to lose whatever equity you have in your home if that happens. So pay back your loan on time. Second thing is you pay your property taxes on time. That goes along with the mortgage payment. It usually comes out of your escrow. So every year, when you get your escrow evaluation in the mail, you should check and make sure that your property taxes were paid on time. If they're not paid on time, a lot of times the jurisdiction like Loudoun County will contact you and say that they did not get your property taxes. Then you get on the phone to your mortgage banker and immediately lean on them to pay your property taxes out of the escrow. And if that happens more than once, you complain to them and say that you're going to take them to the Housing and Urban Development Department, and file a complaint. Also, you have to maintain the sufficient hazard insurance. Usually your hazard insurance has an escalation clause, and it goes up every year automatically based on what your home value goes up in. But it's good to check every year to see, how much the hazard insurance is, and also what they're valuing your house at. Sometimes it can really diverge seriously. So you want to make sure that you're covered for the replacement cost of your house. That's just one thing I'd say there. And then maintain your property. Why that's important is the county or local jurisdiction, like the subdivision, can actually fine you if you don't mow your lawn, or if your house isn't painted, or whatever. So they can even slap a lien on your property and not allow you to sell it until you pay back the lien. So these are the things you need to do when you're a homeowner. Next slide. Financial problems. If you're having problems paying your mortgage because you either lost your job, or you're ill, or you've had a change in your family situation, it's very important to act immediately. Call or write to your lender and explain your situation. A lot of lenders have forbearance programs to help you get over a rough patch. But if you let your mortgage go late several months, they might be less willing to work with you than if you call them immediately. So it's important to stay on top of this and get help when you need help. Also, contact your housing counseling agency or nonprofit credit counseling agency. How do you find one of those? Well, the Consumer Financial Protection Bureau has a website that lists the good ones in your area. And the website is consumerfinance.gov/find-a-housing-counselor. So, or just put in Consumer Financial Protection Bureau and put in Google credit counseling agency, and it will come up. Also, it's important to avoid foreclosure at all costs, because after food, your house is the most important financial priority. You want to have a roof over your head, and you don't want to lose your house and your equity, when you lose your house. Next slide. Here's a very critical thing that I think people do not do very often, but is really important to do, because one of the things about homeownership is surprises happen. The cost, it's important to put aside money, like kind of a slush fund for home maintenance. These costs vary based on the type of home, the location, and the age of the items. For instance, I live in a 1938 old house in Arlington, and things go wrong all the time. I do have a long-standing reserve fund, but we still put an extra $200 a month in that, because our house is old and things go wrong all the time. So to establish a reserve fund, I would suggest when you buy your house, put aside $1,000 or $2,000. You're paying all this money anyway. It's important to put $1,000 or $2,000 away in your housing fund, which is like a savings account or whatever that you have earmarked for housing maintenance funds. Maybe $1,000 or $2,000 when you buy the house, and then monthly, put away a monthly amount to up your reserve, so that you always have this reserve fund. For instance, for that $400,000 home we were talking about earlier, you should put away the purchase price, the $400,000 times 1%, or $4,000. 4,000 divided by 12 is $330 a month, or for a $100,000 home, it would be $83 a month. So every month you should put away this money in like kind of a slush fund, so that if something goes wrong with your house, you'll be able to easily pay for it. And what are the things that can happen? Next slide. There's unexpected repairs like storms, insects, storms like your hurricanes again, insects like termite damage that you might not know you have. Fires happen, and it's not something you're expecting. And leaks, again, you lose the shingle and suddenly you're going to have to replace the roof of like 1 or 2 of your rooms of your house. Next slide. Regular maintenance expenses. That's the other thing that could come out of that home maintenance funds that you're putting away money every month for. Things like servicing your HVAC systems. You should do that every year. In the fall, your HVAC provider usually runs a special between like $50 and $100 to like change the filters, make sure all the parts are working and all that stuff. That should come out of your maintenance slush fund. Replacing major appliances. Over time, your refrigerator is going to die. Your stove is not going to make, you're going to want an upgrade of your stove, whatever. That's something else you can get out of that slush fund. Pest control. You might need termite treatment. Yard care is another thing you can do, changing filters, roof tune-ups, caulking. Next slide. As a justification for why putting that money aside every month in your maintenance repair slush fund, take a look at what costs for major repairs and for houses are these days. They're very high. To replace your roof, and you have to do that like every 20 years, it costs between 10 and 12,000. Same thing for furnaces, also 14 to 20 year life on that. If you have to replace your furnace or your AC, it's going to cost you 10 to 12,000 too. Water heater, they go out probably every 8 years. The new ones that are fancy tend to go out even earlier, 1 to 2,000. Plumbing repairs, $5,000. You can see that these things can really add up. But if you're putting away money in your maintenance slush fund in your savings account, you're going to be able to handle these things. But if you don't, you're going to have to come up with the money anyway, because that's the only way to make your house livable. Next slide. Summing it up, here's the key points we talked about today. Your mortgage payment it includes more than just your sales price, the principal amount of your house. It includes the principal, the interest, the taxes, the property taxes you pay to the locality, and various insurances. Your homeowners hazard insurance, the homeowners insurance you pay on furnishings and appliances in the house. Also your mortgage insurance until your equity is worth at least 20. And then you don't have to pay the mortgage insurance anymore, the PMI. And it's important to set up that monthly budget, that monthly maintenance slush fund that includes setting aside a percentage of your income for unexpected repairs. And next slide. And I think I went over, I'm sorry, we went a little long, but it was a very complicated topic. And I'm really happy to have been here today. And thank you for listening to me.
Wonderful. Thank you, Teresa, for that excellent presentation. Extremely informative and went into a lot of detail on things that maybe our participants maybe weren't aware of. So right now we're going to take some time to answer any questions that may have come through in the chat box. I did see one that already came through a little bit early in the presentation. And this person, I'm assuming, is talking about potentially your $400,000 kind of home price example you've been using throughout the presentation. And this person was curious about maybe how resale values are calculated on a house like that, or how that what a resale value may be on a house that they may be looking to purchase.
Okay, what is she asking about the 400,000?
What is the resale value of a house was the specific question.
The resale value, like if you buy it for 400,000?
Right.
If you fix it up, let's say, you probably, well, if you just sell it immediately, it'll probably still be worth 400,000. Or if you buy it for 400,000 and you keep it for like 10 years, usually housing prices go up about 5% a year. So over, let's say 5 years, it should be worth 25% more. Probably that $400,000 house will be worth 500,000 after 5 years. Is that what they're looking for?
Yes, I believe so.
Yeah. If you upgrade the property, if you put in a new kitchen, make the bathroom nicer, you paint, you do like good landscaping or whatever, you can significantly increase the value of your property, especially if it wasn't in great shape to start with. Most, you should take a look on like things like Angie's List and whatever, and see the return you get on various home improvement things. But most people I know, if you had a $400,000 house and you put 50,000 in repairs and upgrades and things, you should probably expect to get at least another 50,000 in value. So again, if you buy it for 400,000, you put 50,000 in upgrades, you should probably be able to sell it for 500,000 and get an extra 50,000 out of it.
Good. Okay. I just went in the chat box, asked if this person could maybe expand a little bit on what exactly they were asking. While we're waiting to see what their response is on their question, here we go. Oh, this is a habitat specific question.
Oh yeah, I won't know. I don't know exactly how that works. So that will be for you.
Yes. So to answer your question, this person is asking if they will get 50% at the end, and will Habitat get the other 50% if they were to purchase a Habitat house. The specifics of how Habitat works out their loans with families in our homeownership program differ for each family. We look at different financing tools for every family in our program. The best do would be to look at our website, which is loudandhabitat.org, go into our programs and look at our homeownership program. And if you have extremely specific questions, I would reach out to our homeowner manager, which is Edwina Jackson, and her contact information is listed on our website under the homeownership program. I believe that is all that we have time for today. That was the last question we had. So I'm going to go ahead and wrap things up for today. So thank you, Teresa, for joining us. That was extremely helpful presentation. I'm sure a lot of people benefited from it today and will continue to benefit from it in the future, since it will be up on our website next week. So you can certainly go back and rewatch if you had some things you wanted to take notes on from Teresa's presentation. If you're curious about Loud and Habitat for Humanity and our Tools for Life Learning Center, the website is up on the screen right now, loudandhabitat.org/tools for life. And if you go there, you'll be able to see what our next workshop is, as well as be able to go back and watch all of our recorded workshops. So we'd love for you to join us next month on March 10th, where we will also be partnering with Virginia Cooperative Extension, and they're actually going to be teaching on how to budget for utility bills. So this is something you are not going to want to miss. So go ahead and sign up for that workshop, and we hope to see you all again soon. Thank you.
That sounds great. Thank you very much for listening to me, guys.